One, two, three, banana pudding, and we are live. Welcome to another episode of Compounder's Corner. In this podcast, we'll be going over the companies reporting their earnings this week, and we'll be talking about the stock market in general. And this episode is going to be a little different. I'm going to keep it short and simple because it might be the last video, or I guess podcast, that I'm going to be making in my office here in Japan. Yeah, fun fact, I've been living in Japan for the past 4 years, and I just have to say this to you guys. Thank you for giving me a platform and tuning in week after week. It means a lot. And in case you missed it, some videos that were recently uploaded onto the channel, no matter how tired or exhausted I was this past week, I was like, dude, we got to pump out the videos because the upload cadence is about to drop off dramatically soon, right? So number one, an analysis of 8 government-backed stocks that I believe have the potential to be the next Intel. Not all of them have high conviction, but nonetheless, 8 different business operations. And then number 2, a dedicated deep dive video for Nestle. And then number 3, yes, I'm telling you, we almost got back to the old days of uploading 1 video per day, but we did 3. Yesterday, I uploaded a 24-minute video about why I'm still investing in stocks during all-time highs. And now let's turn our attention to this week. On a high level, here are the biggest takeaways. Number 1, we have the cybersecurity giants like Palo Alto, CrowdStrike, we have Rubrik, and then we also have the retail chains such as Dollar General, Five Below, Macy's, and Ulta Beauty. And what happens last week, circling back to that, past week, Costco reported their earnings on Friday. And I say it all the time on the channel, right? Definition of a dividend compounder with cheese. But as a retailer in the business of operating warehouses in North America, Asia, and all over the world, contingent upon the membership recurring revenue, to have a trading multiple of like a 45, 55, 65, I fundamentally disagree with that, right? Costco is a really good pickup whenever their trading multiple gets suppressed down to like a 25, 27, 28 historically, because it usually fluctuates and rebounds right back up to 35, 40, 45. And this past Friday, I think the opportunity is going to come this upcoming week, because on Friday, they sold off. They missed the bottom line expectations. And when your PE ratio is above a 20-25 and you trade for a premium, any mistake like that will send your stock tumbling. Last week, we also had Zscaler, ticker symbol ZS. On a high level, I'm not a cybersecurity guy, okay? Based on my understanding, they're in the business of selling a very bougie VPN that filters all of the data that's going in and out of everyone's laptops in an enterprise or a corporation to make sure that everything is safe and secure. But nonetheless, they reported their earnings and they went 30% in the red. And that's why I make content about earnings, and every single week I tune in. Because the buying opportunities, believe it or not, the earnings, that's usually when it happens, when the market gets really emotional, overreactive, and they punish you really harshly. What I mean by that is they sold off 35%, I think, at the lowest valley. And then the following day, they rebounded pretty aggressively. And then by the end of the week, they're pretty much back up to where they were. I almost jumped in when they were at like 122 a share, but I hesitated. I kind of wish I didn't. Another one, Salesforce also reported their earnings, and I thought it was so fantastic. I thought it was beautiful. And they went red the day after. Kind of crazy to witness, which between you and me made absolutely no sense. However, much like some of the other big names in software, by the end of the week, Salesforce, like Adobe, Intuit, everybody rallied pretty high. And I truly think it's because we're starting to realize that AI is not going to make software obsolete, but rather the exact opposite. The application, the final product, is going to be enhanced and optimized because of AI. And that's what I've been saying the entire time. But not all AI, or I guess not all software is created the same. I had a tier system ranging from tier 1 all the way to tier 4. Me personally, I would only want to invest in tier 1, tier 2, potentially tier 3. Tier 4 is a gamble, but the high quality ones in tier 4 should be fine. And yeah, just like ZS, I almost jumped in, but with Salesforce, I was too busy packing up the household stuff. And it's kind of funny because I remember I was responding to a comment on Patreon talking about how good Salesforce earnings was. And then, yeah, I just got busy. So didn't jump in. I regretted just a lot of regrets this past week. And that's because mentally I'm not all there, right? I'm thinking about the logistics, the flight, the itinerary. We're traveling with 2 dogs and a newborn. It's chaotic. And before we hop in to talk about each day of the week in a dedicated manner, I wanted to talk about this image that I stumbled upon on social media. Essentially, it's suggesting that we are currently, present tense, experiencing the AI bubble. Anthropic, which is the hottest LLM out there, language learning model. It used to be OpenAI, and now it's Gemini. They take turns being the tip of the spear, whatever. Their market valuation, even though they're still private and they're going to IPO soon, is almost $1 trillion. At the exact same time, Walmart, I think they're a dividend compounder with cheese, $940 billion, their market capitalization. The gross sales for Anthropic is $20 billion, and Walmart, their top line is $725 billion. Now, based off of this, by taking a look at one of the highest quality retailers out there, I guess we can say we're in a bubble. But that's not the full truth, because when you think about Anthropic, their revenue growth year over year is roughly 2,900%. And it's a trend that the analysts and everyone else, they're thinking that it's going to continue getting higher, like 3,000, 4,000, 5,000% increase in their gross sales. At the same time, with Walmart, their top line, I mean, they've been around forever. And their scale is so big, they've pretty much penetrated every corner of the market. So for them to be able to increase their gross sales, it's a lot more of a difficult task. And the margins for their industry, razor thin. Okay? Their top line increased by 5% year over year. So I think it kind of makes sense in terms of like who has the momentum, who has all of the hype, who has all of the trajectory. And the market is forward-looking, and it's pricing in aggressive growth in Anthropic and AMD, Google, and the other AI-related plays. And I get it for the most part. Then again, it begs the question, are we in a bubble that's about to burst? Now, I've been really looking into this, and there are some similarities, especially the valuations of everything just being ballooned up to the dot-com bubble crash. But what's different this time around is that we are actually producing meaningful cash from top all the way down the totem pole to the very bottom. NVIDIA, to the utilities, to the construction, to the HVAC, to everyone that's propping up the AI data centers, everyone is thriving. Whereas with the dot-com bubble crash, it was predicated upon ideas, narrative, hype, world-changing, websites, but they were all burning cash. They weren't making money, and they were very speculative. So there is that element, but at the exact same time, with the AI movement, we're seeing circular financing, where the money is just going in a circle from NVIDIA to Meta to Broadcom to whatever, and just goes in a circle. So the money is just going from one hand to the other hand, and they're just exchanging the cash. And then there's also the productivity paradox, right? I think some corporations, especially on a smaller scale, they're starting to understand that AI, even though the pitch decks and the presentations made it sound like it's going to increase the productivity through the roof, 300%, all of that jazz, we're finding out that the cost to implement AI is a lot higher, especially with the errors along the way, rather than just keeping a butt in a seat and paying them 80 grand a year. I think dealing with the AI, we're realizing like, man, it's hard for us to quantify the ROI for us to fire everyone and replacing them with agentic AI or robots or whatever else have you. And then last but not least, my undergrad, my degree was in psychology, so I always like to think about what's moving people. Is it strategic thinking? Is it emotions? What is motivating them, right? And I feel like with the AI bubble that we're in right now, I think everyone is experiencing FOMO. Even the most mundane, unnecessary industries are trying to integrate AI into their space so that their stock can pump. And when you think about it from that lens, it begs that question, right? Are we in a bubble? To be honest with you, I'm not trying to sway an opinion one way or the other, but I'm on the fence. On one side, I'm like, it kind of makes sense. The numbers add up. I mean, I tune into earnings every single week, and I'm seeing that companies are crushing it. Companies are posting numbers that were greater than the previous year. And on the other end of the spectrum, I'm like, it seems like the optimism, I guess another word would be, the greed in the stock market right now is a little concerning. So I don't know. You tell me. Tell me what you think in the comments. To be honest with you, I don't know. I truly don't know. Now, having said that, let's jump to Monday to talk about what's going on. I think I guess there's two companies here that are relevant. Number one, we have HPE. So last week we talked about their cousin HPQ. They're in the business of selling the physical printers and the ink cartridges, which I'm not bullish on. With this one though, they're obviously a parallel play to the AI physical infrastructure that's happening. So based on what's been happening with Dell, Super Microcomputers, and everyone else that's helping the servers, the data racks, and everything else, I think they're going to post a very positive earnings. And I think they're going to pump. So that's HPE. And then there's also Science Applications International. This is a lesser known defense contractor that's headquartered in Nova, or I think maybe in Maryland. Sorry, my memory's a little fuzzy. No, they're in Reston, Virginia. They're kind of like a Leidos, L3 Harris, kind of like a Booz Allen, kind of like an Accenture. Not really, not my cup of tea. Okay? Jumping on over to Tuesday. Can you guys believe that it's already June? I just can't believe how fast 2026 is going. Anyways, Tuesday, we've got some relevant names. We got Palo Alto Networks. See, I don't know if you guys remember, a couple months ago during the software sell-off, I did my homework and I kept thinking about who are the biggest opportunistic plays here, because not everyone is going to suffer at the hands of Anthropic Claude, right? And I kept saying cybersecurity looks really good. I personally just never jumped into it because my reasoning and logic, Microsoft had me on that base. Right? Because they're responsible for Windows Defender and some other cybersecurity stuff that they're working on. So for me, that was my exposure to cybersecurity. In hindsight, I really wish I would have invested into the two big dogs of cybersecurity. The ones that are almost fully integrated to meeting all of the demands of securing a network, right? And that's going to be Palo Alto and CrowdStrike. Now, at the time, I was thinking about jumping into Palo Alto. Dude, they were like 140, maybe like 160. I didn't pull the trigger. Instead, I just dollar cost averaged into Microsoft. Hindsight is 2020. Now that they're at all-time highs, they've never been higher than ever before. For me, I feel like that ship has sailed. It's the exact same feelings that I have with health insurance, except that time I did pull the trigger. I jumped into United Health. I put 30% of my capital into United Health, crazy as it is. I jumped into Centene, and I benefited from it. I just really wish that I had the gonads to have done the same with cybersecurity. I messed up on that one. And then also on Tuesday, we have Dollar General. Don't dismiss them. I'm telling you right now. Their peer, which is Dollar Tree, entirely different business model and strategy. Because Dollar General, I love their business model because they're the Walmart in areas and regions of the US that do not have access to one. So if you think about the middle of nowhere in West Virginia or Nebraska, they're not going to have Lowe's, Home Depot, CVS. They have none of that. But what they do have, a Dollar General in that small town. This is a company that I covered on the channel a few times. And I'm going to be honest with you, I'm keeping a very close eye on Dollar General because at their trading multiple of a 15, I mean their forward PE being a 15, I really like. Now, on a similar scale, but different, the business strategy is kind of similar. That's going to be Tractor Supply Company. I had them pulled up. Ticker symbol TSCO. Much like Dollar General, their forward PE is a 14.5. So their PE ratio is pretty darn low. And very recently, they went on a sell-off, and it's a dividend compounder that I personally prefer over Lowe's and Home Depot because they're not catering towards the home builders and contractors. No. Tractor Supply's target demographic, I think it's kind of hilarious. It's the recreational farmer. Rural homeowners. People that live in the suburbs that are upper class. You would think based on the name, they're trying to cater towards the blue-collar working folks, but no. Their target customer is the mom that wants to raise her own chickens in the backyard because she owns 3 acres in Oklahoma and her husband works an oil rig job and he's bringing in $200,000 a year. They've got discretionary spending. That mom will do most of her shopping at a Tractor Supply Company. And taking a look at their sell-off, the exact same thing is happening to the peers, which is Lowe's. They're also they are at their 1-year low, and the exact same thing is happening to Home Depot. But when it comes to Tractor Supply, I like their future because their business model is pretty unique. Because they're kind of like a specialty pet store where you buy your livestock feed for your horses, your cows, but also all of your chicken equipment. At the same time, you can also buy the most random home improvement stuff, but also clothing. So I like, why is Home Depot on the screen? Let me pull up Tractor Supply for us. So I like their future because as of right now, they're aggressively pivoting to manufacturing and producing their in-house private brands for everything, including dog food, clothing, and hardware. So up until this point, they were only selling other people's stuff made by Carhartt, Wrangler, and all the other name brands. Now they're changing the playbook, private label brands. Remember, I feel really bullish about platforms because they become the toll booth and they get to decide what's going to be on the shelves, and the private label generic stuff, it has higher margins. So that's what I prefer over the individual brands, like the food brands like Campbell, clothing brands, and everything else. Because if your stuff don't end up on the shelves, you're kind of cut out. You're out of sight, out of mind. But much like other discretionary spending operations, especially like Tractor Supply, Lowe's, or even Trex, a company that we covered on the channel very recently, every single one of them, they had their valuation reset. So me personally, I've been nibbling at them, but it's not a big position at all. Like, I'm contemplating going in big so that they'll be a part of the cheese portfolio. But as of right now, I'm just monitoring them and just nibbling a little bit. So Tractor Supply. And then jumping on over back to the list of Tuesday, there's Ulta Beauty. Now, I went on record by saying I am not a fan of them multiple times on the channel. Okay? So they're a retail physical chain that sells skincare and makeup products. They're usually located in like an outlet mall or inside of an actual physical mall. The reason why I'm very bearish on them, even though they are a platform that can sell their own stuff and everything else, the reason why I'm bearish is because I used to be a former skincare model. I know, it's kind of funny, I'm not lying. Yes, in a previous life, I used to be on posters and magazines, and I used to travel being the demo where makeup artists will try new products on my face. Whatever. Kind of embarrassing now that I think about it, but while I'm not bullish on Ulta, I'm very bullish on Korean and Japanese skincare retail chains. In fact, the Korean version of Ulta, known as Olive Young, they just opened up their first store in Los Angeles in California. And so if you're invested into Ulta, I'm not even trying to be rude or negative, but I think this is the beginning of the end for Ulta. Because I think we're starting to realize that American beauty products, it ain't all that. Especially when you compare it to East Asian stuff. Especially as a guy that used to partner closely with these brands. Korean and Japanese beauty products. I'm telling you right now, if you don't believe me, go ask your wife. Who makes the best sunscreen? Who makes the best foundation? Just go ask her and you'll see. And so brands like Olive Young that have their own in-house private label products on the shelves and everything else, I would invest into Olive Young before I ever think about going near Ulta. Likewise, I don't really feel good. Sephora. Another one of those makeup, skincare places, very similar to Ulta. I'm bearish. I would not invest into them. And then, let's see, who else do we have on Tuesday? I think that's it for Tuesday. I think this is not a crazy week, because in previous episodes, sometimes there would be like 500 companies on a single day. So let's jump on over to Wednesday and see what we've got. Obviously, Broadcom, they're going to crush, they're going to soar. How do I know this? Because Marvell just reported last week. It was beautiful. So why would Broadcom be any different? Okay? There's also CrowdStrike. Again, I think the ship has sailed with that one. But Medtronic, I do think, is still at a very, very good valuation. And we just uploaded a video about them on the channel. And I think they're going to set the tone for the other medical device stocks that are under pressure right now. So when we think about Stryker, Abbott, whatever their guidance and narrative is, it's going to send everyone left and right of them either up or down. Because Medtronic is the biggest one in this ball game. So to be honest with you, I'm thinking about jumping in. I don't know what price. Maybe it'll be 69. Not because it's a funny number, but I would have to do a deeper look into their technical indicators. But I think $69 might be my price target to open a position. Maybe I won't. We'll see. And then there's also Viva Systems, ticker symbol VEEV. This is probably one of the highest quality tier 3 software stocks out there. It's a do-it-all for the biotech and pharma space, including the research and development, drug pipeline progress, and GTM marketing. So one-stop shop for the pharma companies like Pfizer, Novo Nordisk, Eli Lilly, but also all the various biotech companies that I do not know because they go belly up all the time. I really like Viva Systems. And if they get sold off for a petty reason, I'm buying. Don't be surprised if I make a video saying, hey, here's my new position, here's why. The one thing that I have to hold against them, no dividends. I really wish they had dividends, but it's not the end of the world. The reason why I really like them, in a former life, outside of being a freaking model, I used to be a strategy guy for one of the biggest pharma companies in the world. And so I had line of sight into Viva Systems, and I know that they're working with proprietary data that AI cannot replicate, or even if you vibe code something that's similar to Viva Systems, you don't have the data of record that's comprehensive like they do across the board for all of the approvals, for all of the regulatory guidelines. And believe it or not, clinical trials and drug manufacturing in the US, very, very strict, and it's regulated. I cannot see vibe-coded software replacing Viva Systems anytime soon. It's a lesser known one, but it's nonetheless very high quality. Five Below, I do like. I bought into them and have profited off of them in 2020 and haven't really looked their way since. But it's the kind of place that you go to buy all bunch of random crap like gadgets, toys, candy, and snacks for under $5. Macy's, which still boggles my mind. I really don't understand why Berkshire Hathaway would sell out of Amazon and pivot that capital into Macy's. I just don't get it. What I also don't get is how the heck are they up 81% in the past 365 days while still only having a PE ratio of a 10 based on next year's EPS? Just everything about Macy's, it doesn't make sense. Me personally, I would not want to invest into a department store. All else being equal, I'd rather go with Target. Because at least with Target, the bullish catalyst in their favor, to become the next, I think they have the potential to become the next Costco without the subscription membership fees. Like that die-hard customer base. Because Target, for the longest time, they had a pretty good reputation with their customer base. Target before Macy's. And then other than that, let's see. Now, let's jump on over to Thursday. I think the rubric, this one, it's going to take me another 3 months to forgive myself. I almost bought into them for $45 a share. Obviously, their lowest point was $42.25, so I wouldn't have timed it perfectly, but I remember I canceled my buy orders. So I was like, wait, what if they go down to $39.99? I'll jump in when they're $39.99. Lo and behold, they never got to $39.99. Had I just bought into them at freaking $45, I would have been up by a significant amount, right? Potentially, well, is that $45? Well, at $53, so their current trading price is $78, it would have been an upside of 51%. I just didn't do it. When I think about all of the opportunities this year where I hesitated, I get a little upset with myself. I think, I don't know if you can relate to me on this or not, but whenever I think about the opportunities that got away because I hesitated or because I canceled the buy orders, and then I watched them soar, I'm like, dude, you were almost there. You literally just had to click one more button. It's hard. It's really hard. But then again, if I look at my transactions and my portfolio, this past year, year to date, I'm doing pretty well. So I have to remind myself of the facts. It's like, dude, it's not like you're losing. It's not like you're doing poorly. The ones that got away, you can learn your lessons and move on. And I think the lessons that I have learned with the software sell-off is, I think there's two dynamic polarizing forces. I think there's a force that's like shorting, hoping that they fail. And on the other side of that spectrum, they want them to thrive, rebound, and rally. Case in point, you take a look at some of the software names, whenever they sell off harshly, with due time, in a week or two, or maybe 3 weeks, they rally right back up. So I'm starting to pick up on the pattern and on the trends. Likewise, with the cybersecurity stocks like CrowdStrike or Palo Alto, if they go down 30, 40, 50% because of their earnings, potentially for me, that would be a buying opportunity because in due time, I'm not going to say it's going to be 100%, but I feel like that rebound story is pretty cognizant with what's been happening with the broader software space. Now, I don't think that's going to be true with everyone. I think the lower quality ones that sell off, it's for a good reason. Like they're not, there is no place for them in 2028, let alone in 2035. But when we think about names like ServiceNow, Salesforce, to a lesser extent Intuit, SAP, Oracle, these are companies where, as crazy as it might sound, when they go on these huge sell-offs, could be a buying opportunity. I mean, for me, I think I doubled down on Microsoft as my big software stock, but also SAP. Microsoft tier 1, SAP tier 2. But I feel like I'm starting to open up to the idea of jumping into a tier 3, right? Like Viva Systems and even tier 4. So next time, I think I will. I mean, obviously they've been rallying for the past like 30 days, but we'll see. If the opportunity never comes, it's okay. Because I think right now the opportunities, it's in other sectors, or other industries. Medical devices primarily, that's where my eyes and attention is at. Yeah. Anyways, Thursday, there's Lululemon. This used to be one of the hottest stocks ever. They penetrated $511 a share in 2023. Now they're $131. That's why I really, really hate buying stocks that get too ballooned up in valuation, that has too much hype in it. Because whenever I look at stories like Lululemon, 511 dropping down to 131, or PayPal also being hundreds of dollars dropping down to like 40, I get scared, right? Much like Nike, Lululemon, it's so sad to see. They're falling out of favor with the masses. Because Lululemon's entire brand and identity, it's based on athleisure wear, like yoga pants that are really tight. And every single one of their clothing articles, I'm pretty sure this is factual, it's polyester, like a specific type of plastic fabric that's really comfortable. Even though it's polyester, it's pretty darn comfortable. I mean, my wife likes Lululemon, but the fact of the matter is, in 2026, the trend right now, just like Nike, how they're out of favor, the trend is not with them. The trend is getting back to natural fibers like bamboo, wool, cotton, linen, silk. That's all the rage. I've been keeping up to date with some of the fashion influencers just because, I don't know, I don't really have a fashion sense anymore. Like, you talk to some people in the modeling industry, you go in two paths. You either continue to wear Dolce & Gabbana, Ralph Lauren, Polo, or these high-end brands, or you go the other direction where you turn to Adam Sandler, right? After you wear some of the hottest names on runways and everything else, you just kind of lose passion for clothing altogether. And so I turned into Adam Sandler, right? And then I realized, like, bro, I don't really like the way that I look, right? And so I've been trying to upgrade my wardrobe, and I've been following some fashion influencers, and yeah, they keep me up to date with what's going on. That's how I know, like, Nike is also falling out of favor with the sneakerheads, people that used to buy and resell Nikes. Like, even that scene and industry, it's dying. Just everything about Nike, it's kind of sad to see. And honestly, not to be a negative Nancy, but I don't have high expectations for Lululemon and their earnings, even though their top line has been consistently positive since 2017. I think the final nail in the coffin for me was when Lululemon took Costco to court or something like that, right? Because Costco, they were selling the Kirkland private branded Lululemon pants for like $14.95. The exact same time, Lululemon, they were selling their pants for like $175. And I think the outcome, I think the court system was like, get out of here. Costco is allowed to sell yoga pants that are inspired by your pants because it doesn't have the Lululemon tag on it. And once people found out that you can get the exact same pants, like, guys, that's why I'm more bullish on the platforms that have the capacity to do the distribution but also the toll booth mentality of what goes on their shelves, but also the private label brands. They've essentially eliminated Lululemon from their shelves and started selling their own Costco Kirkland stuff for a fraction of the price. And it's not just Costco. We're also seeing it with Walmart Great Value. We're seeing it all across Europe, Asia. Everyone is doing it. And that's why my perspective on retail chains completely changed from business school. In business school, my opinion, based on what we were seeing, retail chains were going to be a dying breed because of Amazon, and everything was going to be an e-commerce, online distribution, supply chain. Like, how good is your fulfillment centers? Because we were in the pandemic, which did consequently cause a lot of retail chains to shut their doors. I think the saddest one for me, I went to seminary in Southern California. It was Biola University, the Bible Institute of Los Angeles. And one place that I used to frequent a lot with my pastor friends was Soup Plantation. It's a place that it's all you can eat. It was like $8, but the food options limited to just salad and like 8 different varieties of soup. Places like that went belly up. So the pandemic did cause a lot of retail chains to close doors, to just never open up again, right? But at the exact same time, now we're seeing that online shopping was just a fad at the time. I think customers still want to go to a place where they can try it on, where they can touch it, feel it, experience it, and buy it there and then, especially if they do price matching, right? If it's the exact same price at Walmart.com as it is in store, you're just going to get it in store, right? And then you also don't have to mess around with shipping. With the minimum fees. I don't know if it's like $25, $35 for shipping. Dude, I've been living in Japan for so long, I don't even know what the shipping fees are in the US anymore. But anyways, now I'm super bullish about retail chains like Tractor Supply, Walmart, Costco, Target. I'm starting to see the light. They're not going to sell these individual brands like Reebok, Adidas, Nike, or whatever on their shelves, or Carhartt, Wrangler, Levi's. No, they're going to start selling their own branded stuff and their margins. I think the growth story for retail chains is insane. Because I think everyone probably had the same line of thought that I did, right? Walmart and Amazon going to make all of them obsolete, but now it's the exact opposite experience. It's pretty interesting. That's why business for me, maybe you can hear it in my voice. That's why I'm so passionate about it. It's always evolving. And by keeping up with the times, you can make a lot of money, right? If you're stuck in your own ways, you're stubborn, or you dwell in the past, you're not going to make much money. But if you're able to think in the future, trends of like what is going to dominate a specific industry. Likewise, not to toot my own horn, the best example that I can give is like, I don't care who's the president in office, I'm still investing, right? And once I learned that the current party in power, they were going to win it all, I started doing a lot of research on the military stocks, and I started investing heavily into it, right? Likewise, at the exact same time, when a Republican is the president, historically, we see several industries suffer for the entire administration. Number one is firearm sales. So Smith & Wesson and some of the other firearm producers, they're struggling. And I think the psychological reasoning is people feel like when a Democrat is in office, they're going to have so much more strict rules and regulations to the point where they just want to buy all of their firearms right now, rather than risking it. But when a Republican's in office, they know that the rules surrounding firearms is a lot more free, so they're not going to replace or stock up or buy more ammunition. Does that make sense? Likewise, I'll give you one more before we move on. Renewable energy, green energy, anything to do with wind, turbines, hydro, solar, all of those spaces have suffered greatly because I think we've rolled back all of the, I guess, trying to keep things clean, but rather we're doubling down on oil and gas when a Republican is in office. So understanding these trends and historical patterns, you play to it, use that to your advantage. And that's why I put a crap ton of money into Huntington Ingalls, Oshkosh Corporation, Lockheed Martin. And it played out. I mean, it took some time, but it played out. Likewise, when a Democrat takes office, there are also other spaces that thrive. When a Democrat's in office, I'm calling it right now, oil and gas, it's going to tumble like you've never witnessed before. Reason being is because all of the bullish tailwinds that they've been experiencing since 2024, it's all going to get rolled back. So it's going to be, it's like a back and forth battle. That's why I'll double down on what I just said. I truly do not care who's in office. I'm still going to be investing, and I'm going to be investing in what works. Hopefully that makes sense. There's also Service Titan. Basically, it's a tier 3 vertically integrated software for everybody and anybody in HVAC, landscaping, everything, right? It handles scheduling, estimates, billing. I really like Service Titan. However, if we're going to be operating with that framework and mentality, I would prefer, gosh, what's the name of that company? Toast. They do the exact same thing, but only for restaurants. From orders, the menu, reservations, this logistics, everything. So Toast for me is a higher quality tier 3 software than Service Titan. Other than that, let's see, jump on over to Friday. I think there's only one worth mentioning. There's ABM. Now, this is a lesser known stable dividend payer in the waste management world. Why do I say that? A 3% dividend yield, 59 years of growing their dividend growth rate of 13%. So I think very recently I uploaded a video about Nestle. And I said, if you're looking for a very stable passive income payer, don't look at Nestle. Don't look at Hormel or Campbell. Instead, look to the grocery stores or people that are in the utilities, or adding this in right now, the players that are in waste management. Because till the end of time, we are always going to need recycling, garbage disposal services, and everything else in between, right? So ABM for me would be a better pick than Nestle. I think everybody knows about waste management, Republic Services. Me personally, I like Waste Connections the most. But ABM, circling back to who the heck they are, what about the janitors that are keeping warehouses, office buildings, and airports clean? For a lack of better words, that's what they do. They provide janitorial staff that clean physical properties. A very simple business model. I wouldn't say that it's a dividend compounder, but it's more of a passive income payer. I kind of think of them as like a bond with a 3% dividend yield with the potential upside of a stock. So, ABM. Other than that, guys, before I head out of here, because I really do got to get back to packing, I still can't believe I'm leaving Japan, right? I'll miss it a lot, but I get a lot of my thinking done whenever I walk the dogs. I don't think I'll miss it too much, though. I think 4 years is enough time to fully get integrated with the society and to try everything out and to experience the highs and the lows. So I'm more so looking forward to the next chapter and the new journey ahead, because there's a lot of changes that are coming to the channel. I'm really excited. My hands are tied behind my back, I feel like, because I'm operating here in Japan. But once I'm back in the States, gosh. But anyways, I truly do appreciate all of y'all for loving the channel and supporting the content. It doesn't make much money, but every little bit helps. Thanks to you guys, I'm able to do this as a stay-at-home dad, so I just feel really blessed and fortunate. Now, for the rest of this week, for the rest of the year, if I don't get to talk to you again, stay safe, good luck in the stock market, and take care of yourself and those that are around you. I love you, and I'll talk to you really soon. Hopefully, I can make another video or two before I get out of here, but we'll see. No promises.